He wrote the book on value investing. One of the best minds in finance today, Bruce Greenwald has been described as a guru to Wall Street's gurus. And over the last 3 decades, he's passed on his deep knowledge of economics to generations of students, along with the help of famous guest speakers like Warren Buffett and Mario Gabelli. In this episode of Influencers, I'm joined by Bruce Greenwald, Professor Emeritus of Finance and Asset Management at Columbia Business School, as we discuss the economy, his philosophy around value investing, and coming up on the right side of the stock market. Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Bruce Greenwald, Professor of Finance and Asset Management at the Columbia University Graduate School of Business and Director of the Heilbronn Center for Graham and Dodd Investing. Bruce, nice to see you.
Nice to see you, Andy.
So you are known as perhaps the most prominent value investing professor in business schools today. What is the difference between, say, being a professor of finance and being a professor of finance who specializes in value investing?
I think it's a world of difference. I think, first of all, being a professor of finance is increasingly a matter of technical mathematical work and models that are still rooted to an extraordinary degree in efficient markets theory, although there is increasingly this field of behavioral finance. But what value investing, I think, is about is understanding that practitioners out in the world, and this is how I was introduced to it, have a much better handle on how to invest successfully in theory and in practice than the finance profession. So it's really almost a renegade discipline at this point, although in the last 20 years, it has made an extraordinary advance in the academic community. So I would say almost every leading business school now teaches a value investing course, which is really quite significantly at variance with traditional finance.
Well, that's interesting. So these people would perhaps knock heads even, at least academically?
Well, if you understand the pathologies of academic life, they should knock heads, but of course they completely ignore each other.
I don't know which one would be worse.
I think ignoring each other because it leads no place.
Right. Okay. One thing, and people may not know this about you, Bruce, but you are sort of a direct tie from Graham and Dodd to Warren Buffett and the Columbia Business School. Can you talk about that whole sort of group of individuals and how it all sort of ties together, including
yourself? So there has been an evolution of the value investing tradition intellectually. It starts obviously with Ben Graham and David Dodd. They are really essentially gone by the mid-1960s.
And they were professors at Columbia, right?
This is at Columbia, but it doesn't really exist anyplace else at all. So by the time I was teaching at Harvard Business School in the 1980s, it was essentially a dead letter in academia and had been replaced by efficient markets. A guy called Roger Murray kept it alive at Columbia. And I think he retired sometime around 82, 83. And then, strictly by accident, a family that had been investors with Buffett decided to give a chair. The Heilbronn family decided to give a chair in value investing. And it was hard to fill. So I had already just come to Columbia, and the dean said, "Why don't you take this chair?" And I said, "Sure," not knowing at all what I was getting into. And then a year later, Mario Gabelli had decided to run a series of seminars at the Television and Radio Museum with Roger Murray, who at that point I think is like 84 years old, and was literally like an anthropologist recording a dead language. And the dean came to me and he said, "Look, as a matter of courtesy, you should go listen to at least one of these lectures." So I went to listen to one of these lectures, and it was clear it was just much more intelligent than anything we were teaching our students. and sort of talked Roger into teaching a course with me first that Warren Buffett came to speak at, and then developed into a book and then a sequence of courses, and really metastasized to a lot of other schools, including Harvard Business School, which developed its own value course. So really, from those beginnings in the early 90s, I think you've seen a change. And I think, Andy, to be honest, there are very good reasons for that. And it is simply this, that even though there is overwhelming statistical evidence that markets are not efficient in the academic sense, in the sense that nobody can forecast them, because there are these well-established patterns of momentum and the outperformance of value stocks. The fact of the matter is that there is an inescapable sense in which markets are efficient. And it is simply this: the average return to all investors, asset class by asset class, and therefore all overall asset classes, has to be the average return to all assets. Because everybody owns everything. Something is owned by, nothing is an orphan asset. And the derivatives, the uncovered shorts and so on, net out. There's a buyer and there's a seller, so that the average return to the market is the average return to all investors. And that means you have to ask yourself, how are you going to be in the upper half of that distribution? And that's not a question that traditional finance people have ever asked themselves. And actually, value investing has a sequence of good answers to that.
And can I interrupt? Does
Sure.
that speak to the tension or the argument between the value investing camp and the efficient market people?
Well, I think that it should, again, but the fact of the matter is that in the face of all this overwhelming statistical evidence against efficient markets, in the face of all the developments in behavioral finance that provide psychological underpinnings for these violations of efficient market behavior, most of the efficient market people just have not adapted. And I think the value people have. It's basically the ideas that they have are, look, if we look intelligently for opportunities where investors like myself or like you are more likely than not to be on the right side of the trade, we're going to do better than average. And one way historically to do that is to take advantage of the irrational overpricing of lottery ticket stocks, the growth stocks, and the irrational underpricing of the ugly, obscure, despised stocks. And that's for a long time what value investors did.
But why, if markets are efficient, then why does Buffett say that you should invest in an index fund?
Oh, but okay. And I think that that's a good point. To do well, to be on the right side of the trade, you have to be a professional investor. So I'll say something that ironically should absolutely dominate the investment world and doesn't, which is, if I'm going to be on the right side of the transaction more often than not, I probably ought to be a specialist. So you don't have internal medicine guys doing orthopedic surgery. Medicine law is highly specialized. Mm-hmm. And if I've spent my whole life trading onshore, South Texas Gulf Coast oil leases, and that's all I do, and you fly in from Germany and buy an oil lease from me, who do you think made money in that transaction?
Right.
And the idea of specialization plays no role in academic finance, Adam Smith notwithstanding.
But does this suggest that for ordinary investors, then they should pretty much stick to index funds, maybe unless you're in a field like, say, you're a dentist and you see that this new product is going gangbusters and people don't seem to realize it, and then you buy that stock?
That is a very good way to put it. The problem, of course, with that is once the dentist does that in dentistry, he decides he's a market genius and he decides he can do it every place. No, you have to be incredibly disciplined about why you're the person who's going to be on the right side of the trade. And most part-time investors are not equipped to do that. But if you just buy the index, you can't be on the wrong side of the trade.
Right.
And it prevents you from over-investing in the glamour stocks. And that's the sense in which Buffett is absolutely right.
So it's not just, holding a sign up and saying, I'm a value investor, so therefore I'm going to be right. That's sort of meaningless. In other words, you have to A, have the strategy, but B, have to be able to execute the strategy.
Yes,
Those
yes.
people can't do that.
Yes, and that's exactly right. You have to be specialized. You have to understand by industry and even by geography these days.
Right.
You have to be, because you're an industry specialist, good at judging managements and knowing if you're going to intervene with management, because activism is increasingly important, where you're going to find a good alternative management if the management doesn't go along with it. So you need a lot of detailed knowledge. You need a superior valuation methodology, because you have to know what you're buying. And a DCF methodology is almost worthless. I mean, if you think about it, there are 3 things wrong with it that are so obviously it's incredible that it's taught in business schools. So the first thing is, and this is the most obvious, if you think about what a DCF is it's
what is a DCF? I'm
oh,
sorry.
it's a discounted cash flow valuation.
Got it.
So I estimate the cash flows into the future and I weight them. And then I add up the values of the individual cash flows. The problem is that the reliability of my estimates of those cash flows are very different. So I don't have a very good idea of the 5 to 25 year out cash flows, but I have a very good idea about the current cash flows. But a classic discounted cash flow calculation doesn't make that distinction. So what you wind up doing is you wind up taking very good information, which is your estimates of the near cash flows, and very bad information, which is the distant cash flows, and adding it together. And as any engineer knows, you add bad information to good information, the bad information completely dominates. There are also no strategic ways to, if there are no easy ways to integrate strategic insights into a complicated sort of DCF calculation. And third, and I guess this is important, is that in the DCF calculations, they're all forward-looking. They're all estimates of the future. You completely ignore the balance sheet. And throwing away information that's as crucial as balance sheet information is not a good way to proceed. And there are value investing approaches that are pioneered by Graham, Buffett, and Roger Murray and other people that really don't have those problems.
Right.
And if you're not willing to make the investment to learn and practice those, you shouldn't be in the business of pretending you're a good investor.
And I wanted to follow up and ask you about Warren Buffett. You mentioned that he came to your class that one time, but has he come to your class more than that? And what's that been like?
Okay, so the history of that was, I think in the first 8 years, because he came every second year, he came 4 times. It may have been 3 the first 6 years. Then he invited the classes to come out to Omaha. And that happened for a number of years. And that happened every year. And then, I think we still go out there, but we go out there as part of a bigger meeting with him because he is more efficient with his time.
That must make for a pretty robust enrollment in your class. Do people just want to come in because they want to, not only hear from Bruce, but they want to hear from Warren?
Well, okay, you would think they would be intelligent enough to do that. But here's the problem. If you look at the empirical data, in the years where he didn't show up, the enrollments were just as high as the years where he did show up. So
that's very hard. You being a draw as well, Bruce, perhaps.
Well, I think it's the subject matter that's the draw. Yeah. I mean, I think that understanding how to value growth stocks without sort of putting this extraordinary emphasis on the future cash flows that you can't measure, understanding how to use the balance sheet, understanding how to use the fact that in the automobile industry, there are never going to be any competitive advantages or barriers to entry that are significant. That takes you a long way. And I think conventional investment courses don't teach people to do that.
Okay, quick tangent off that point. When you say there's no barrier to entry in the auto industry, would you include Tesla in that?
Oh, absolutely. So going forward, absolutely. Now, Tesla will do a little better. I mean, there's an easy way to measure barriers to entry. So the first element is what's the minimum market share you need to get to in order to be viable? Now, if a market is small, like the electric car market is today, you probably need to get to 20% of that market to be viable. In the mature automobile market that is global, you can be viable at 2%. Well, at 20% requirement, Tesla may be able to keep rivals out. But at 2%, nobody's going to keep anybody out. And guess where the electric car market is going? It's going from 700,000 a year to 7 million a year.
And so just to follow that point, that would not necessarily bode well to your thinking for Tesla shareholders.
Oh, absolutely not. I mean, 20 years from now, you really think that they're going to dominate the auto market? Not a chance. And we know what a competitive auto market looks like, because in that market, most of the big companies have flirted with bankruptcy at one time or another.
But just to follow quickly, like, Elon Musk will say, it's not just a car, Bruce Greenwald, it's an ecosystem with a computer connected to a database, connected to solar panels.
Yeah, go ahead. And you think other car makers don't have that? They don't have computers, they don't have databases, they don't have solar panels?
Right.
I mean, give me a break. And if you're going to have charging stations, Apple always used to try this. When they tried iTunes, they tried it only working with Apple computers, and the iPod didn't work at all.
Right.
So when you have charging stations, they're going to serve all the cars.
Right.
So no, Elon Musk is talking his book.
Yes.
But when it happens is a tough question. It will happen. But
well, does that go back to the market can stay irrational longer than you can stay solvent?
I think so, especially in things like this.
Right.
I would not try and short Tesla. People have gotten slaughtered doing that. I've had my own terrible experiences with shorts. And the thing about shorts is you have a short horizon because it's uncapped on the upside.
Right.
But if I were going to put the family fortune into Tesla, I would not be a comfortable doobie.
Right. What other, besides Buffett, I know you've had a number of other high profile people come to teach your class as a guest. What are some of the other people who come?
Oh, okay. So the standard names are Seth Klarman, Glenn Greenberg, Tom Russo, Lee Lu, who manages Charlie Munger's money, Mario Gabelli, Michael Price, and then, just a number of younger people who we've promoted who've done very well.
That's fantastic. And so is there a high demand for your class? I mean, do you have to?
Well, I mean, all right, now I got to be frank with you. I retired 2 years ago.
Yeah, right.
And passed it on. But we basically gave it all the time I was there in the biggest room at Columbia Business School, and we filled it.
Right. Did
but
people
for the
not get into the
speakers,
class, though?
Sorry?
Did people not get in?
We try to look. The thing about information is it's free. If I'm going to talk, I'll talk to as many people as possible. So we tried to uncap the class. Now, for the speakers, because they really come wanting to interact with the students, we capped it at, I think, 60 people.
So I want to ask you a little bit, Bruce, about the market right now and your take on things. And boy, there's all these little substrata. There's SPACs, there's crypto, there's GameStop. I bet you're a big fan of all those things, huh?
I would stay away from all of it. The thing about the market today is we are in the middle of an economic transformation that has for 20 years now and will continue to be extraordinarily favorable for stocks. So we are in the process of a transition from a manufacturing economy with big global markets to a service economy with local markets. And as we talked about, local markets are the markets with barriers to entry. So in local, say, caffeinated soft drink distribution, you have to get 25% share. And in service markets, because there are continuous relationships between the customers and the companies, the demand tends to be really sticky. So typically, for example, companies in these smaller markets, and technology has driven markets to niches too, have to get to like 15 to 25% of the market. And maybe 1% to 0.5% of the market changes hands every year. So you're talking about maybe 30 to 50-year paths to viability. So you got to get to 25% at 0.5% a year. That's 50 years to get to viability. So barriers to entry are going through the roof. And behind those barriers to entry, you've got sustainable monopolies and sustainable oligopolies. And that means you've got pricing power and you have profits rising with that pricing power at the expense of wages. And again, this is data that you would think would be all over the place. But in 1990, the profit share of US national income was about 8.5%. Today, it's about 13%, and it's going to continue going up. So you are riding a wave in which, in these protected markets by moats, you earn more than your cost of capital, so investment returns are high. Organic growth doesn't just attract entry, it benefits the incumbent firms. And cost cutting benefits the incumbent firms. So I think, as you've seen recently, profits are going to do really well. And the market is, if you look at that in general, likely to do really well. But what you need, obviously, is firms that understand dominating small niche markets. And unlike Tesla, don't want to rule the world.
So you seem to be talking about certain companies. Are you talking about the
Well,
FANG
let me talk
stock?
about the one that, again, years ago, I actually got in a fight with the rest of the value community over, precisely on this issue of the transformation economy. And that's John Deere. I don't know if you remember, but people like Jim Grant said, oh, it's the government that's sustaining all this demand for agricultural equipment. It's going to go away and they're going to get trashed. Well, what had happened was they went from being a manufacturing company, and you can see this in terms of what the employees do, to being a local service company. And it consisted of ordinary service support and parts. And then with precision agriculture, now all these machines are run off GPS systems, and every seed is individually placed with fertilizer and pesticide at exactly the right time in exactly the right place. And the software that does that is, of course, local. And that's done for Deere machines. Thirdly, the machines don't wear out because they're plastic. So you have big secondhand markets, and those are local. And finally, because these machines do so much work, you have family farms now of 10,000 acres, they cost a lot. They can charge a lot because if you've got 90% Deere machines in a geography, nobody's going to buy a Kubota tractor because they can't offer those infrastructure services to the same extent, and they're not going to buy an AGCO tractor. So Deere can charge a lot, and that means they finance it. Well, the knowledge of who's a good risk for financing is also very local. Local banks are much more profitable than global banks. So they've understood this transition from being a globally competitive manufacturer to dominating in a disciplined way a succession of local markets. So they have a very disciplined geographic strategy globally. They don't go after wet agriculture in that group. And you've seen what's happened. Their margins in a good year used to be 8%. In a bad year, they're 0. Now in a good year, they're like 18 to 20%. And in a bad year, they're 12%.
Right.
And you look at that stock, it's gone from 75 to well over 350.
And so it sounds like there's sort of a whole group of these kinds of
Oh,
companies.
absolutely.
And it sounds like you're actually fairly sanguine about the market, and it's somewhat justified that the market's at elevated levels then. I'm wondering if the FANG stocks, Amazon, Google, those types of companies also fit this sort of description.
Okay. Google is classically this kind of a company, and it's in technology space, not geography. It does only search. And that's a narrow function. Remember, IBM used to do everything.
Right.
And they absolutely dominate search. And that makes a huge difference. And whenever they try and do other crap, they just lose money. So that's a case where as long as they continue as they do to set a first priority on dominating search, they're going to make a ton of money.
And what about
Microsoft?
Amazon? Go ahead.
Sorry?
What about Amazon? I was going to ask you.
Amazon is really interesting. I mean, Amazon has done really well in cloud computing, where it's been very specialized and dominated the market, although that's going to get to be a very big market, I think, and it's going to be harder to dominate. But where they have been disciplined geographically, they've done well. Where they haven't, they've done badly. So they pulled out of China. India's not working particularly well. If they would concentrate on dominating geographies in the United States and other markets one at a time, I think they do a lot better. Because if you look at their retail operation, it hasn't really made money except for Amazon Marketplace.
I want to go back and ask you, we talked a little while ago about China, but just to get, you have a contrarian take on that. I want to hear that again, which is you don't think we really have to worry about China.
Oh, absolutely not. I mean, the world is moving to services. And the thing about services is, in addition to these small markets that are local, is that service institutions are small and decentralized. That means that you have to allow firms to exercise and managers to exercise local initiative. That's a huge change from manufacturing, which takes place in big institutions where you can concentrate a lot of resources. A rigid system like China is not going to be good at decentralized operations. That's the first thing. Second thing is that when you go to services, individual performances are what matter. It's individual doctors, it's individual professors increasingly, it's individual lawyers and so on, if you think about that, architects, salespeople, and so on. Well, the thing about that is it leads to an uneven distribution of income. And smart people do really well. Smart people don't want to live in China anymore. I mean, we see that in the students who come to the United States. So they're going to be lousy at services, which is going to be 90% of the global economy. Just as agriculture disappeared, manufacturing is going to disappear. For the same reason that agriculture did, productivity growth is going to be much higher than demand growth. And they're not going to have the people to do well in services, and they're not going to have the structure to do well in services. And you can see manufacturing dying already. I mean, in China, the trade data is absolutely indicative. I mean, exports are growing at roughly 2% a year. That suggests an economy that's growing a little more slowly than that. So no, they're going straight down the tubes, and it couldn't happen to a nicer bunch of guys.
Wow. Okay. Let me ask you about our economy and the Federal Reserve and fiscal and monetary policy, which have been, very accommodating, and probably rightfully so, given we had a global pandemic. But too much? Are we too reliant on cheap money?
Oh, I don't. I think the answer to that is no. And it's for a rather peculiar reason, which is that when we did all this extraordinary monetary expansion, all the quantitative easing of buying bonds and so on, it had no detectable effect on the macroeconomy. So if you look at the Fed's forecast, they always think they're going to get to 3% growth 2 years out and meet their inflation targets 2 years out. And the growth stayed at 2 or was slightly below that. And the inflation rate stayed right around 1.5%. So it had no effect in the long period since the financial crisis. And it strikes me as very odd to think monetary policy, at least, is going to have any effect going forward, which means that if inflation takes off, we're going to have a tough time controlling it with monetary policy. Fiscal policy has never worked particularly well. I mean, to give you an idea of the historical weakness in fiscal policy, and admittedly, this is going to date me because it goes back a long way. In 1966, there was a very sharp contraction in the expansion of the money supply. In 1967 was the year of the most rapid expansion of the Vietnam War. And wars are fiscal policy on steroids. Nominal GDP growth between 66 and 67 fell substantially.
Right.
And, except for sort of tax cuts and giving money away, it's very hard to detect because of the complexities of the timing of government expenditures, the effect of fiscal policy.
Quick follow-up question, Bruce. So is inflation a threat now?
I think in the short run, it's going to be brutal. And again, I come back to the fact that we are now an economy that is increasingly 70% oligopolies and local monopolies. And there are also situations where these service firms who are dominant are always trading off present returns, which is high present prices, against future growth in attracting customers. I think when the government scares these firms, they're just not interested in investing in the future. And I think the government has scared the crap out of them, and they're going to protect themselves by using the pricing power that they have, which is why you saw this extraordinary spike this year in even core inflation. And I think the event was actually not monetary or fiscal policy. I think it was the vacating of the vaccine patents. And I think businesses are going to look at that and say, holy these guys are not my friends. I got to protect myself. And the easiest way to do that is to raise your prices. And when all the other local businesses raise their prices too, you don't even lose that much business.
Wow. All right. We're going to have to leave it at that. A good dose of contrarian thinking, I would say, from Bruce Greenwald of the Columbia University Graduate School of Business. Bruce, thanks so much for your time.
Thank you, Andy.
You've been watching Influencers. This is Andy Serwerk. We'll see you next time.